Well, first of all, emerging markets have weathered the crisis quite well compared with the past. As you know, in the past, central banks would tend to hike interest rates in order to prevent sharp currency depreciations. On this occasion, they have managed to reduce interest rates and indeed going one step further to intervene directly in government bond markets in order to stabilize them. And this is in part testimony to the improvements in general macroeconomic picture and structural improvements in their economies and indeed in the monetary policy frameworks that we have seen over the years.
Clearly, there's been a fairly large reaction on markets with the dollar decline as investors have weighed up Fed policy, and that's had implications across on emerging markets, but also here in Europe on the currency. What do you make of how far we've run? I mean, in the report you cite the fact that the Franco-German recovery plan was also positive for euro strength here, but do you think the dollar decline has much further to run from here based on policy?
Well, again, honestly, I don't think that anyone can predict where currencies are going to go. And again, if I had a crystal ball, I wouldn't be here. What I can say is that the dollar has depreciated largely because of cyclical factors, because of the narrowing, as we say in the quarterly review, because of the narrowing in the yield differential vis-a-vis other currencies. On top of that, as you rightly mentioned, the depreciation, which has been particularly noticeable vis-a-vis the euro, has also some origin in the European economy, in the euro area, as a result of signs of greater fiscal as well as political cohesion. But exactly where the dollar will go, we will have to see depending on how circumstances evolve.
Claudio, I feel as though many of us need a crystal ball at this point. There's so much uncertainty, but the report was very interesting in that it pointed towards credit conditions, and you point out that there's a persistent deterioration in issuers' credit quality in recent months, yet markets and many corporates are banking on very low corporate bankruptcies at this stage. How concerned do we need to be about the mindset changing? Because from the outset, it felt as though no one was going to be allowed to fail, yet as we progress, it feels as though government pockets are just not deep enough for that type of mentality.
As I mentioned earlier, we are shifting from the liquidity phase to the solvency phase of the crisis. And at that point, a key issue, which is particularly challenging, will be to take a view as to which firms are viable and which firms are not viable, particularly in light of the longer-term changes in demand patterns that have been induced by the pandemic. That, of course, will involve also a role for governments. Now, as regards to the question of how prospects might be going forward in terms of policy, there is clearly, as we note in the annual report, there will be a need at some point to shift to a more targeted form of interventions. That's not for today, that's not for tomorrow, or even for the day after tomorrow, because, of course, the economy, as we mentioned earlier, remains fragile and the outlook is uncertain. And here, governments will have to, or policymakers in general, will have to strike a delicate balance between providing too much support for too long, which can, in the long run, weaken the economy, or withdrawing it too early, which, of course, can create economic damage. But the broad direction at some point, which is to move towards a more targeted approach, is clearly there, and there is a consensus about it.